Hey friends, welcome back. In my last video, I talked about China and the economic struggles happening over there because of the zero COVID policy. If you're an investor interested in China, that video is a must-watch to understand what is stopping Chinese equities from continuing their advance. In today's video, we're going to talk about the US housing market crisis, how unaffordable everything has become, and whether we're going to see a massive slowdown in housing, if not an outright crash. All this is important because housing is a major component of the economy, and its trickle-down effects have major implications for consumers and the stock market. If we're meeting for the first time, welcome. Welcome, my name is Larry, and I'll be your investment strategist where I talk about the US and China macro and equity strategy. I see the economy presenting some serious challenges in the foreseeable future, so it is my mission to help you stay level-headed and be equipped with insights. Just a quick thank you to FTX US for sponsoring today's video and my channel. More on this innovative company in a moment. And also make sure you're on my email list where I send out periodic thoughtful emails. With that said, let's get started. I'm going to spend the bulk of today's video talking about the housing crisis in the US, and then the last few minutes talking about global macro issues, China, Russia, and Ukraine. One of the biggest challenges facing millennials today, including myself, is the cost of home ownership. For a lot of people, owning a home is now getting more and more difficult. The median home price in the US is close to $400,000, and if you live in a high cost of living city, often much higher. Last year, mortgage rates were under 3% for a 30-year mortgage loan. As of right now, we're seeing the 30-year mortgage rate at around 5%. If the Fed continues to raise interest rates with their intended pace, it's possible that mortgage rates could get to 6% or even 7%. Now, if you're interested in buying a home, the cost of the mortgage interest just became significantly more expensive than it was last year. And even if you're not interested in buying a home yet, and you're a stock market investor like me, you're witnessing the home builder sector and the home improvement sector bear the brunt of the sell-off. Home Depot is 30% off the highs, so is home improvement company Lowe's, and Home Depot is a major component inside the price-weighted Dow. The Home Builders ETF XHB is off 25% this year. So when you have home prices that are already unaffordable and rising interest rates, well, you have one of two things that will happen. One, home prices will come down right away, or number two, interest rates will bring down the rest of the economy, and then home prices will come down. Now, I heard that smashing that like button will slow Fed hawkishness, so do that right away and share this video with friends and family concerned about US housing. Now, the Mortgage Banker Association recently came out indicating that the volume for loan applications fell by 6%. Wells Fargo indicated that mortgage origination fell by 33%. And the US home builder sentiment also dropped to a 7-month low because of surging interest rates. Another real estate data brokerage company, Redfin, is citing that sellers are forced to cut home prices as they try to sell their homes with the housing market weakening. And several other research observations that Redfin put out is the following: that fewer people are searching for homes for sale on Google. And in addition, the mortgage purchase applications were down 6% from a year earlier. And also, they're attributing a lot of the slowdown in mortgage volumes because of the 30-year mortgage rate. Now, the one real estate company that still has a bullish outlook on real estate is Zillow, where they expect to have at least 2 more years of strong demand before enough supply hits the market to soften demand. However, it's important to note that Zillow has sometimes been overly optimistic about their forecasts. Now, the primary metric that I'm looking at is whether these mortgage origination firms are hiring. And so far, they're actually starting to lay off a lot of their staff. While major news outlets are not yet prominently discussing this, mortgage origination professionals are starting to feel pressure as mortgage rates rise to uncomfortable levels for first-time home buyers. Now, if you want to diversify your longer-term investment strategy during these crazy times, I want to take a moment to talk about our sponsor today, FTX US. FTX US is a US regulated crypto exchange founded by Sam Bankman-Fried. They have a complete crypto and finance app that allows users to buy crypto and NFTs with no fees and will soon launch stock trading. FTX US also recently raised $400 million at an $8 billion valuation and is now one of the largest exchanges in the world in terms of trading volume and users. You might have seen FTX partner up with Tom Brady, Steph Curry, or even the Miami Heat Stadium. They recently have also partnered up with the Major League Baseball teams as well as tennis megastar Naomi Osaka. You can use the FTX app to buy your favorite NFTs with no gas fees and also up to 85% lower fees than other top exchanges. Download the FTX app today using my referral code down below, Larry Chung, to earn free crypto on every trade over $10. Just downloading the free app supports my investment research published here on YouTube, so thank you again for your support. Okay, so let's get back to the video. Guys, it's happening. Sectors of the economy that are most sensitive to interest rates or interest rate expectations are already seeing layoffs occur. If housing sees a dramatic slowdown, the wealth effect will start to take hold where consumers start spending less. And according to Fed data, housing typically consists of 1/2 of US household net worth. Falling home prices will weaken consumer spending, and that will reflect in earnings results and outlooks in the coming quarters. And if the outlook softens, we can expect unemployment to start rising. In fact, after Netflix's latest quarter, I expect them to start laying off employees. And in my Patreon community, I issued cautionary notes on Netflix in my March and April investment research updates. I did a quick email update to my public list, so check that out down below. And we could witness the job market flip from hot to cold in just several quarters if layoff starts happening quickly. Now, the Fed has several major FOMC events coming up, 3 this summer in May, June, and July, and then another 3 this fall in September, November, and December. The Fed hasn't even raised rates significantly yet, but we're already seeing the following implications. 30-year mortgage rates skyrocketing, mortgage origination professionals getting laid off, home builder sentiment being at a 7-month low, and consumer confidence continuing to weaken. And in the stock market, we're seeing the following effects. Home builder stocks being down 25%, home improvement stocks, which are usually very stable, getting hurt, and also the technology sector taking a beating. The only beneficiaries in the market right now are energy, counter-cyclical consumer staple companies, and also healthcare. So will the US housing market simply soften or crash? Well, that depends on whether we see multiple 50 basis point hikes, because if we do, I think a soft landing would be pretty incredible. Hey, this is my opinion, but I think a soft landing has as much credibility as transitory inflation. Now let's bring our attention to global macro. The final part of this video is very important for my global investors listening here. China's zero COVID policy continues to be unrelenting. I continue to believe that this is the roadblock that is keeping a lid on the Chinese economy, and therefore consumption-driven companies like Alibaba, JD, and Meituan will demand continued patience from investors. I hold out for the fact that once zero COVID is softened, this sector will see strong, renewed enthusiasm. Now, the PBOC, which is the People's Bank of China, recently did a cut in the RRR, but held the interest rate stable. And in my previous video, where I said that zero COVID would most likely make China stimulate hard to keep the economy afloat, we're already seeing monetary easing play out. I continue to believe that since inflation has yet to become a big problem in China, they have leeway to increase their stimulus, but they're going to do so carefully. So to understand the stimulus potential, you need to watch their monthly inflation figures. The potential for China to combine monetary easing with fiscal stimulus is an option that the US currently does not have. But bringing it all together with one of the major risks that I'm watching globally that could derail everything and bring fear back into the markets is if Russia takes aggressive action against Finland and Sweden for considering joining NATO. Russia's Putin is very serious about securing their borders, and the recent escalation with Ukraine has caused Finland and Sweden to make a decision on potentially thinking about joining NATO in the upcoming weeks. And in a recent YouTube video that I did with you guys on my community tab, it seems that 50% of you think that they might join NATO. And in other words, if that ends up being true, we've got a black swan in the market swimming by in plain sight. So let's hope that cooler heads prevail. And in the meantime, if you're someone who wants to navigate the stock market and the tech sector's recent volatility, take a look at my email list down below, where one of my recent publications gives an exclusive sample of one of my bi-weekly reports. Hit the like button if you enjoyed this video, share this video with friends and family, and thank you again to our sponsor, FTX. And don't forget to sign up for the FTX app down below in my description with my code LarryChung, where every $10 trade and above earns you free crypto. My friends, trust the model, and I will see you in my next video.